This proportional diagram illustrates a $1.75 trillion valuation target. That single block represents the upcoming SpaceX IPO. It dwarfs the combined market capitalizations of Coca-Cola, McDonald's, Disney, Nike, Starbucks, and every major American defense contractor. The immediate question is, who is going to voluntarily buy into a company at the highest valuation in human history when that same company is actively losing $5 billion every single year? The answer is you. Within a few weeks, your 401k or retirement index fund is slated to be the biggest buyer of this stock, and you will not have a choice in the matter. This forced purchase is happening because Nasdaq quietly rewrote its foundational index rules with exact mechanics designed to facilitate this specific listing. To understand why those rules had to change, we have to tear down the public myth of what SpaceX actually is. It is not a unified Mars colonization company. It is a fragile stack of three entirely different businesses layered on top of each other, masking severe financial flaws. The first and ugliest third of the business is xAI, an artificial intelligence lab founded by Elon Musk in 2023. A few months ago, SpaceX acquired xAI in an all-stock deal that valued the AI entity at $250 billion. By March of 2025, every single one of xAI's 11 original co-founders had walked out of the company. The core technology requires a complete foundational rebuild from scratch, all while the operation burns through roughly $1 billion a month. This bar chart compares the valuation to revenue ratios across the top AI labs to show the extreme market distortion here. OpenAI generates roughly $24 billion in revenue annually on an $850 billion valuation. Anthropic generates over $30 billion on a $400 billion valuation. xAI generates an estimated $1 billion in revenue, yet commands a $250 billion price tag. The second tier is the rocket business. When people hear the company name, this is the hardware and the launch infrastructure they picture. Despite holding all of the public's attention, the rocket division generated roughly $4 billion last year. That accounts for only about a quarter of the company's total revenue. An imploding AI lab bleeding cash and a structurally sound but surprisingly small rocket business cannot mathematically justify a nearly $2 trillion price tag. The third tier is Starlink, a satellite internet provider that acts as the critical crown jewel that actually pays the bills for everything else. The sheer scale of the network is staggering. There are over 10,000 Starlink satellites in orbit right now, beaming internet down to 10 million active global subscribers and generating $11.4 billion in revenue in 2025 alone. This line graph tracks Starlink's internal efficiency, showing how profit margins have violently accelerated. In just 2 years, margins expanded from 41% to 63%. That efficiency is now spreading far beyond consumer internet. Starlink has aggressively expanded into maritime networks, commercial aviation, and a highly classified defense tier called Starshield, securing lucrative contracts directly with the Pentagon. When you combine Starlink and the rocket branch, the two core operations brought in an impressive $8 billion in profit last year. But the catastrophic cash burn from the newly merged xAI dragged the entire consolidated corporate structure down to a $5 billion net loss, despite doing $18.5 billion in total revenue. A massive conglomerate bleeding $5 billion annually cannot survive a natural IPO price discovery phase. For this enormous valuation to hold, artificial demand has to be manufactured to sell it to the public. On May 1st, Nasdaq implemented the Fast Entry rule. It functions as a regulatory red carpet rolled out right before the company's targeted June IPO. This timeline shows the first major change. Historically, a newly listed company had to undergo a mandatory 3-month price discovery seasoning period before joining the index. The Fast Entry rule compresses that 90-day span down to a mere 15 trading days. The second rule change abolishes the strict requirement that a company must have a minimum 10% free float of public shares. This perfectly accommodates SpaceX, which is targeting an unusually low 4 to 5% float. The third rule change introduces a hidden multiplier. It creates a legal loophole forcing ETFs to treat floats under 20% as if they were 3 times larger than reality. That 5% slice mathematically acts like 15% inside the index. These 3 changes completely bypass normal market physics. They legally force passive index funds to buy into an unprofitable stock at its maximum possible valuation within weeks of the listing. The CFO of SpaceX recently confirmed they are planning to dump a massive 30% of the IPO supply directly onto retail investors, completely breaking from historical IPO norms. This creates a precise timeline trap. Index funds are forced in early at peak prices via the 15-day rule, artificially propping up the valuation right before insider shares unlock, allowing those insiders to cash out at the top. The automated mechanism that makes passive index investing so safe and effortless for your retirement is the exact feature Wall Street is using right now. They are weaponizing your own index fund to force you to be the unconsenting exit liquidity for an unprofitable company.